Hello, Sector Watchers. Welcome to the 5th episode of Sector Spotlight on Tuesday, the 29th of October. This is your weekly update on sector rotation, anything remotely connected to sectors, relative strength, and our rotational analysis. My name is Julius de Kempenaer, and I am your host for today's show. With me are Zach Dillon for the technology and my producer Rachel, who will help me with questions and steer me in the right direction. We're trying to make this an interactive show, and we encourage everybody to participate in discussions and ask questions. The email and social media channels are open 24/7, and the live chat is open now. And we will keep an eye on that, what's coming in, and possibly answer as much as possible while we are on air. So here is the agenda for today. We'll be taking a look at asset classes and sector outlook and looking back at what happened. I will combine that with combining weekly and daily RRGs, and that's following up with what we've discussed last week, where we talked about the differences between weekly and daily RRGs. We'll have a short break. If you have any questions or suggestions, we'll discuss them. There is at least one that came in this week via email, which I want to talk about. And then I'd like to take a better look at the financial sector for today, because I think that's an interesting thing to talk about. Anyway, here we go. Bring up my screen, bring up my RRG. On the left-hand side, we see the rotation of the various asset classes over the last 5 days. And in the leading quadrant, very comfortably, is SPY, that's equities, while the lagging quadrant is populated by pretty much everything that is fixed income related. Real estate inside weakening and heading further down, and improving is commodities. Interesting, because commodities been underperforming for a very long time. I am not sure if this is the turnaround, but for the short term, it looks interesting. If we move to the sectors, because that is where most of our focus will be, then let me go to the daily update first, because that's the short term. That's since we last spoke. And we see this 5-day rotation, and the one thing, the leading sector on this daily RRG right now is financials. As you can see, it's inside the leading quadrant, it's heading up the right direction, it's leveling off a little bit, it's doing pretty good, followed by healthcare, XLV, and we still have that energy sector wide away. It's now well inside the improving quadrant, but it's still very far to the left, very low on the JDK RS ratio scale. So that remains a matter of concern. And if you look at the scale, then utilities and energy are pretty much at the same RS ratio level. XLE to be preferred because of the heading, XLU, but these are the weak sectors for the time being. Now, if we look at that from a weekly point of view, we got a little bit of a different situation, and this is 5 weeks. Let's move that to 3, so we got a little bit more detail here. We see the utilities, real estate, and staples, traditionally the defensive sectors, dropping steeply with very long tails. And we see financials and industrials is right there, improving together with materials. This is a little bit clustered, and we still have that energy sector and improving very far to the left. But this tells me that there is a rotation going on, and I'm writing a blog article. I had actually hoped to publish that before the show, but the thing is that we're actually pretty lucky that I'm here on time today, because in Europe we switched off daylight savings time this weekend, and I just didn't realize that. And when I was in my car earlier today to pick up my daughter, and I looked at the clock, and the clock is still off. And I was like, oh my God, that means that Sector Spotlight is now an hour early for me. So I came, crushing back, and we're all good, but it was like I was almost an hour late for the show. Anyway, while I was writing that blog, I am talking about the fact that we now see a lot of these sort of vertical rotations on that weekly RRG, and these are vertical rotations, vertical moves. And these vertical moves are very sharp turns. And these sharp turns on the RS momentum axis indicate a very sudden rotation out of or into a specific sector, rather than, you know, a very nice smooth rotation that goes, you know, moves on both axes at the same time and creates this nice oval type rotation shape that we like to see. Anyway, Mr. Market is throwing us a couple of curveballs. That's cool, that's fine. That's why we're here for, and that's why we use RRG to analyze them. Now, a couple of sectors, because obviously, I mean, I'm not here to talk about the S&P and the market and what direction, etc., because there's a ton of commentators and people on StockCharts and everywhere else who are doing that. I'm sure that all of you have now picked up that the S&P has made a new all-time high. And, you know, whatever you think about the market, that is a bullish sign. You know, if you're at all-time high levels, that's not a bear market. That's not negative. As a matter of fact, it's very positive. What I try to do is to combine that fact, that information, that fact, with what I see on my RRGs. And I'm going to bring back that beta spreadsheet that we discussed a couple of weeks ago, and a lot of people asked me for a copy, and they should have had it. Now, here is that ranking for sectors according to the beta over the last 12 months. And if we now look at where these sectors are on the RRG, and we see utilities, real estate, staples, they're in the bottom part, and then there's healthcare. Now, if we look at healthcare is here, that's also moving down. So we've got staples, healthcare, real estate, utilities, either inside leading or weakening and moving steeply down, or inside improving and moving steeply down. So that's, especially from a momentum point of view, a negative. Now, if we look at the sectors that make up the upper half of that ranking, then we have energy. I still think it's an outlier, but it is the sector with the highest beta, which, you know, in this theory, is supportive of a general bull market. But then if we go to industrials, that's over there, that's going in the right direction. We go to financials, that's over there, that's going in the right direction. We go to technology, here you go, and remember what we say about stuff that's inside weakening and turning back up. Select that. Oh, there you are. So we came down, and we remember about the sharp turns that I mentioned. This is one of them. So that is very interesting. And then there is discretionary. Unfortunately, that was the sector that I focused on last week as being positive. Well, that didn't really work out. That actually turned down rapidly. Let me zoom that in, and you can see that strange hook that we've seen there. So I'm not really happy with that one, but it's right in the middle. And for a broader market perspective, I think that this beta ranking pretty much fits the narrative of the S&P breaking to higher levels. If we go and look at some individual charts for these sectors, then I'd like to focus. Let's start with technology, because that is pretty much what drives this. Technology and financials, I think, are driving the market. That is a sector that is breaking to new highs. Now, be careful. This is a weekly chart, so this chart is only a day and a couple of hours old. So we still have like more than half a week to go, 3-4 trading sessions to go. So it can still change, but the fact that we're breaking above this level, I think, is pretty positive. Relative strength looks all good, and this is where we see that rotation curling back up while inside the weakening quadrant. So technology is one of the leading sectors. Now, the other one that I'd like to focus on with you is, let's start with industrials here, because industrials is right pushing that to that all-time high, pushing to that overhead resistance level. Let's round it off at like $80. That is, I think, a very, you know, it's been peaking above it. I remember that we talked about breaking it to new all-time highs here in these 2 weeks. It didn't happen. drop back, and we're now at another attempt. And you know that the more times a level like that has been tested, the heavier it becomes to break. But when it breaks, it's a serious break, because I always compare that to a spring that's being, put under pressure, and there is only so much pressure that spring can take until it breaks, and then it loses all that tension and it releases it. And what you will very often see in situations like this is that there is a sort of vacuum of supply right beyond that 80 level. So all that demand that is pushing it higher comes into thin air, and can cause an acceleration of that price higher. In terms of relative strength, we're at support and we're trying to pick up. I think that's what the RRG is showing you, that relative strength is being picked up right now, and we're moving into the right direction. Now, financials is, I think, at this time, one of the most interesting sectors. Why? Let me highlight it on the RRG, because I think that what we've seen here is a sector that's been, and I've lengthened it to 10 weeks right now to show you how almost nothing happened to that tail. It was very stable right in the center of that chart, and over the last 2 weeks, and this last bit here is this week. That's actually today and yesterday's price action, and that's accelerating into the leading quadrant. Now, what I want to bring into the game here is combining daily and weeklies. We've discussed the difference between daily and weeklies last week. Now we're going to combine the two in our analysis. Because when I see a situation like this, where you have a sector that is, pushing into the leading quadrant on the weekly RRG, I almost always immediately switch to the daily to see if that daily rotation backs and supports that weekly, or is it something that's going to drag it down. And when we do that for financials, we see that financials, as I showed you in the look back, is now the highest sector on the RS ratio axis, and it's well inside the leading quadrant. It's actually leveling off already a little bit. So it's this move here, this 10, 12-day move, that has caused that acceleration over the last 2 weeks into the leading quadrant on the weekly chart. So I think that the dailies are now pulling the weeklies higher, which is a good thing. And we are sort of in a break in terms of relative strength. But if you look at what's happening on the price and relative chart on a weekly basis, we see this break here. And what I really, really like is this break in relative strength. We're obviously breaking this downtrend line. And I've played around with this trend line a lot this morning to actually put it in, because you can actually, draw so many trend lines. But my problem with a lot of people drawing trend lines is that they this is probably where most people would start drawing their trend line and then pick like either one of those. But the thing is that if you draw a trend line like that, I don't like that, because you're missing too many highs there, and there are simply not enough touch points. I like trend lines that have a lot of touch points. More touch points means more reliability, and we've seen 1, 2, 3, 4, 5 here, maybe a little bit, and we're trying to break above that overhead resistance and relative strength. I think it's going to succeed. The break in price here is definitely going to be a catalyst, especially when it's going to break that all-time high that we have here. I think it's about 29 something. So that's the level to watch. But the real resistance is the level that we're breaking right now. And we see that the RRG lines are coming to life at the bottom of that chart. Now, if we push this one to a daily chart, and now we're actually interacting and combining daily and weekly price action on both the RRG and the price chart, you see that that break is much more pronounced on the daily. We're actually already last Friday we broke, and we're managing to pull through this week. So that 28.50 level on the daily, if you're not in there yet, I think this should be a good buying opportunity because we're breaking to new highs, because that relative strength is accelerating, because these RRG lines are getting higher. this provides a low risk entry because you've got such a pronounced support level now that you can put your stops anywhere between, let's say, 28 and 28.50, depending on your risk level, which gives you a very good entry point without too much hassle and too much nervousness in your trading. I'm going to wrap up the sector part here. Technology and financials leading. These are two sectors with very high betas, which I think is positive for the market as a whole. So I believe that the break in the S&P 500 is a positive thing. It's very likely going to be sustainable because we've got two of the biggest sectors, financials and technology, that are driving the market right now. I have a hard time seeing the S&P crash to anything lower. Any dips, S&P, financials, and technology are probably new buying opportunities. Let's go to a quick break, and we'll be back after that with a question and some more financial stuff.
Today's market volatility provides savvy traders and active investors with an abundance of profitable opportunities. At the Traders Expo Las Vegas, November 7th through 9th, over 75 of the most respected traders in the world, including Dennis Gartman, Tom Sosnoff, Todd Gordon, and Tom DeMark, will explain how they're adapting their strategies and share the specific trading opportunities they've identified in equities, options, forex, futures, cryptocurrencies, and more. Claim your free pass to join them at tradersexpo.com.
Stocks are the asset class. Equities is the asset class. Small caps are part of stocks. Mid caps are part of the stock universe. So the asset class is stocks. And if you want to break that down, either in mid caps, small caps, like size indexes, or you want to break it down in sectors, that's all fine. But I think that the asset class is stocks. And in terms of gold, the asset class is commodities. And precious metals is a subset of commodities. And commodities is part of the subset precious metals. So here you go. That's the reason why I don't include gold as such in the RRG. But you know, if you work on your own RRGs and stock charts, you can just add gold into the mix, just adding it to that thing. And here's your gold. And now you can look at gold in relation to the other asset classes. That's all fine with me. Reason I'm not doing it is just what I gave you. And I see that there is one question that came in from Dan. Since banks report earnings first, and these were overall good, isn't it the driver of XLF's uptick? But will this hold? Good question. We're actually going to talk about that in a minute, because that's one of the things that I was writing my blog on that will be released probably anytime after the show. And you know what? Let's just dive right in, because he's got a good point. Let me bring back that, we had the financials here, and now we're going to dive in, and we'll call the XLF members. It's a bit of a mess because XLF is one of the bigger sectors. Another page that I always try to keep handy is the spdrs.com website, and because it gives you so much information in terms of sectors. Or let me start with SPY. If I start with SPY, and I want to know, because I said, XLK, XLF, XLI are driving the markets right now. Now, if you look at holdings and you look at sector allocation, you see what the ETF is, how the ETF is allocated, and how the index is allocated, and they're like spot on. That's what an ETF does. But if you look at the sectors, then information technology and financials together are like 25% of the market. So you got two of the biggest sectors that are driving the market higher at the moment, and then industrials is still at a rock solid 9%. So over 30%, over 1/3 of the market is showing very strong rotations, and the weaker rotations for utilities, real estate are only minor. The only one that's not so good is pretty big is healthcare. But overall, the heavier sectors are driving the market. That can only be positive for the market as a whole. It's very difficult for the S&P to drop if those two sectors are going higher. Now, if we move to XLF, you simply key in XLF, and it will give you all the information about that ETF, that sector. And what I always try to look at is the holdings, because it gives me an idea what the biggest holdings are. And I'm going to keep this on the side. Now, one of the things that you can do when you load up this RRG with all these financial stocks, you scroll down to the table, you see that obviously they're all inside the financial sector, but you'll see that there is also a breakdown into industries. And to get a proper grip, and this comes back to the question about the banks, driving XLF. Yeah, that's right. That's what they do, and I think that they will still continue. And the best way to do that is to sort this table on the industry, because right now, instead of sorting it per quadrant, per tail, we're now sorting it on the industry. And if you just simply scroll down, you see that asset managers are, improved. So it's a little bit mixed. But if we are in banks, they're predominantly in the green, in the leading quadrant. There's a few inside the improving quadrant, and there's only one inside the weakening quadrant. Now compare that to the insurance stocks. You got like property casualty insurance, life insurance, insurance brokers, full line insurance, all that stuff, everything that has insurance in it is to the bottom of the graph. They're either weakening or they're in lagging. So it's very, very clear that the banking part of the financial sector is the part of the market, is the industry that is driving financials higher. Now, I had prepared, you can actually set up RRGs and save them. And what I did here is I saved an RRG which only holds the banks. So this is a subset of the one that we've just been looking at. And let me change that to, I don't know, 4 weeks. And you see a very nice positive stance for almost all of these names. There's only one that is not at a heading between 0 and 90, and that is US Bancorp. And that's inside the weakening quadrant. So that's a stock that I definitely want to look at. Let me work my way, because I know that I jotted down a few stocks that I wanted to have a better look at with you. Let me start with the most important ones, because otherwise we'll run out of time, and I'm not sure how long I will speak about that. So in my financials holdings, I think that, and that comes down here, because what is the important one? JP Morgan, 12.3%. If you look at JP Morgan, now let's look at JP Morgan here. That is a stock that is driving the market. It is inside leading. It's at probably 40 degrees angle, 40 degrees heading. That is strong. It's gaining on both axes. So let's have a look at how JP Morgan looks. And I wrote about it a couple of weeks ago, and this one is really following through. We broke to this new high here. We're following through. That relative strength is bringing to new highs. RRG lines are pushing higher. So this is the stock to watch, and probably buy on dips. I wouldn't chase it right now, but buy on dips, because this one is leading the financial sector higher, and it's leading the banking sector higher. So that's the one that I really wanted to get out of the way, because I think you should actually be aware of this one, what's going on. Another one, and I wrote about that in last Thursday's Don't Ignore This Chart, and that's PNC Financial Services. And this is one of these stocks that was inside weakening and started rotating back up, and it jumped into leading, and you see that it is now accelerating above its resistance level. It has now very clearly cleared resistance and relative strength, and it's gaining on both axes. So PNC is another stock that I think you should really pay attention to inside the banking industry. There's a little bit more upside potential than JP Morgan. There is some overhead resistance at this old high, but that's still $6 away. If that breaks, the only way is up for PNC. Another one that is worth looking at, and that's another big one, is Citigroup. Now, here we have another one that is actually just into lagging, started immediately rotating back up, spent only 1 week inside improving, and is now pushing into leading. And if we bring that up on a normal chart, then you see, again, very typical banking chart. If you browse through a number of these charts, you will find that they're all showing this very typical pattern. You can probably see it as an inverse head and shoulder, although there is no real trend to change. But nevertheless, the characteristics are there. This is, whether you call it head and shoulders or not, this is an overhead resistance level, and it is been broken. We still need to close the week, but it has a lot of upside potential, and that relative movement, that relative rotation, really gives me good hope. The one that is rotating lower on the RRG is US Bancorp. And if you bring that one up, it's actually very interesting, because I think this is a very interesting chart. And this is one of the situations where we have the weekly, it's inside weakening, but let me quickly swap this to daily and bring back that USB. Look at where it is here on the daily. So this is driving it. This could be driving that rotation higher. On the weekly, inside weakening and rotating back up. On the daily, already in leading. On the weekly, breaking to new highs. And if we switch this to a daily chart, you can see that we've already cleared this one. We're now working to clear this all-time high resistance or high resistance level. I think this is a pretty good one to look at with a lot of upside potential. Anyway, this was the 5th episode of Sector Spotlight. Thank you for watching. Please keep those questions and suggestions coming so we can make sure you and I are on the same page. I hope to see you back next week, the same day, same time. That's every Tuesday between 10:30 and 11 a.m. Eastern. Meanwhile, if you want to read more about sectors and RRGs, please go to the RRG blog on StockCharts.com, or even better, subscribe using the link below each article to make sure you will receive a nudge every time a new article is posted.
Hi, this is going to be a quick 2-minute video about how to put industry groups into your chart lists or make a separate chart list for an industry group. First of all, clicking on Advanced Scan Workbench. Second of all, scroll down here under the stand components, and you can either pick US or Canadian. I'm just going to pick Canadian because it's not the default, but obviously if you did the US, you'd just go the same way. So you're going to pick Canadian, and in this particular case, we want to find healthcare. It's a group that's doing pretty well. So you could either do the individual industry groups, or in Canada's case, the healthcare sector is less than 60 stocks. So we could add them all. So we put it in there. Don't forget this add button shows up as a line up here. Then you run the scan, and then available actions. You're going to go in here and store these results in a new chart list. You can name it whatever you want. I have a particular naming convention that I like to use that I described in my book, and it is to put the H in there for an alphabetical sort, and so I'm just going to say Healthcare Canada. And with that, that puts it into an industry group list. And you can see here's all my industry groups. I've got other ones in here. But the bottom line is then that way you can sort them and do whatever you'd like. So in this case, they're sorted by scooter ranking, and then you can also look at them by intraday, 1 week, 1 month, and you can also say hide other columns. So with that, I'll leave it. But in general, that's how you can quickly get industry groups into a single chart list. Thanks for taking the time to join me.